Hey everyone, in this video I will explain the debt crisis in the USA and is it inevitable? What will the effects of US defaulting on its debt be on Americans and the rest of the world including us? And can you potentially benefit from an event like this? So let's get started. The US has a 120% debt to GDP ratio and there are concerns about US defaulting on its debt. But what does all of this even mean? Let's understand debt with a simple analogy. Imagine you're young, you're smart, and want a loan for studies, business, or even leisure. A bank will lend you because you have the income potential. You seem capable of paying back. So you take the loan, you use it wisely, you make profits, and you repay on time. Over time, this builds a strong credit history. And as your income grows, the banks are happy to lend you more. But years later, suppose your spending grows faster than your income. And as you age, your ability to earn slows. Now debt piles up, repayments become harder, and eventually your credit rating falls. Banks charge you higher interests, and if you fail to pay repeatedly, no one wants to lend you anymore. Something similar can happen to governments. Like a person aging, America's economy is slowing. Fewer people are skilled, productivity is stalling, and living costs are soaring. The US government borrows money to fund infrastructure, defense, welfare, etc. If not borrowing money, the government would need to, at an unprecedented pace, either increase revenue by either somehow growing the economy or increasing tax revenue, or they would need to spend less by cutting budgets or reducing subsidies, both of which are extremely difficult. Reducing budgets and cutting subsidies is extremely unpopular, and to increase productivity of a country takes decades. Governments, however, have a tool that individuals like you and me don't. They can create money. In the US, the Federal Reserve can inject money into the system through a process called quantitative easing. In QE or quantitative easing, the Federal Reserve buys government bonds with this newly created money, which helps keeps the borrowing costs low. It's like the government wrote IOUs and gave them out to people, and later the Fed comes in and says to those people, "Hey, I'll take those IOUs off your hands and give you fresh money instead." So essentially, the US government issues bonds in return for money and then later buys its own bonds back from investors with the new money printed out of thin air. This way, there is more cash floating around and the borrowing stays cheap. This looks like a cheat code. The US government still borrows easily, the investors get paid, the economy gets liquidity. But here's a catch. If too much money is printed, inflation rises, making everything more expensive. Food, housing, education. The US has been able to use this tool more than other nations because dollar is the world's reserve currency. But if inflation keeps rising and investors keep losing trust in the dollar, the demand for US bonds could fall, forcing the interest rates to go higher. And that is when the debt becomes much harder to manage. So while printing money delays the problem, it doesn't erase them. In the end, the citizens have to pay through higher inflation and reduced purchasing power. This get out of jail free card is kind of an option only for the US because the dollar is the reserve currency of the world. A reserve currency is a currency that is used in almost all of the international trade by almost all countries, which is why pretty much every country has to hold at least some dollars in their national reserve. If a non-reserve country like India decides to use this strategy of printing rupees to get out of debt, it might work for a few times for a very small debt, but it would lead to the devaluation of the rupee. And rupee is not in demand globally, so it will become an unstable currency. And eventually, nobody would want to issue a debt to India in rupees. They would rather issue debt in US dollars, which India cannot print. Hence, this strategy is extremely risky and inefficient for most countries. The US has US dollar, which is the reserve currency of the world, which is why it is the safest currency to hold in the entire world, and US treasuries are the safest bonds in the entire world. However, this can change if somehow the dollar loses its status of a reserve currency. Generally, 60 to 70% of debt to GDP is considered manageable. but the US currently has a 120% debt to GDP ratio. The US is paying $1 trillion as interest payments, which is even more than its own defense budget. Now, this is very scary, but this wasn't always the case. In fact, it was only 55% in the year 2000. Then came 9/11, when US started a war against terrorism. It was fighting multiple wars on multiple fronts in multiple continents, and this led to the debt piling up. And this was the first event to ruin the US's financial trajectory. Soon after, in under a decade, happened the 2008 housing crash, and US took on unprecedented amount of debt to bail out banks and support the economy. This single event doubled the US's national debt, and after this there wasn't one single serious attempt to reduce the debt. It had reached to around 100% debt to GDP, and COVID-19 was the final nail in the coffin. Since then, it has always hovered around 120% debt to GDP. To prevent this, US has a debt ceiling, which is the legal amount the US can raise, and it is currently at around 41 trillion, up from 36.6 trillion before, and US is already at a debt of 37 trillion. So this is a crucial point, but this won't be the first time that US will raise its debt ceiling. It has done this 80 times in the past to prevent an economic heart attack. And every time the debt ceiling is raised, the grave is dug deeper. And will this time debt ceiling be raised again? This brings us to an important part. Two scenarios can play out whenever the debt ceiling is near. One is if Congress votes in favor of increasing the debt. The US buys some time to navigate through this crisis. And second, if the Congress doesn't vote in favor of increasing the debt ceiling. In this case, the US defaults on its interest payments and it faces an economic heart attack. It's always a big political fight. Everybody's got their angles. It's less about the numbers and more about who's got the power. For the debt ceiling to be raised, the agenda must be passed in the Congress with a majority. Look, the guys in charge, the president and the ruling party, they want the debt ceiling to be raised, no questions asked. Why? Because if the US defaults, it is a big economic disaster. And which president wants a default on their term? So they just keep rolling over the debt. They just keep kicking the can forward. Think about it. Market crashes, people losing their jobs and everything. A president letting that happen in their watch would be the end of their political career. Their main goal is to keep things stable so that they can stay in power. And they've got the most to lose if things go sideways. What about the opposition? Then you've got the opposition party who knows that a default would be bad for everyone, but they see this as their big chance. They're trying to hold this as leverage against the ruling party to force them into cutting spendings and basically showing to the voters that it's them who actually cares about the fiscal responsibility and just making the president look weak. If they can make the president to agree to stuff like budget cuts or even increasing taxes, that would make the president look weak and that would be very unpopular and that would be a win for the opposition. So it's a giant negotiation every single time. The president and the ruling party, they tend to give in to some of the demands of the opposition party and the debt ceiling gets raised. This is how it usually plays out, given that everybody is being reasonable and nobody is letting their ego get into the way. But this isn't a one and done deal. The US will keep hitting new debt ceilings because the US keeps borrowing, and every single time the opposition will try to flex even harder. This can get very ugly if US politics is chaotic. If the president is unpredictable or has a massive ego, does he? I don't know. Or if the opposition is just completely fed up. If nobody yields, US will default just like that. Now, how likely is a default to happen? Currently, it seems very unlikely. Because everybody has way too much to lose in case the US defaults. So the debt ceiling will be raised again and again. But is the default impossible? It is improbable, but it is very much possible. And it might look unlikely now, but who knows in the future, it might not look that unlikely. Now, what would the implications be on you in either case? in case of a default or a slow death of the economy with quantitative easing. If there is a default, you would see the worst market crash in the history of all markets all over. There will be layoffs. The Indian IT sector will be the most impacted because of the kind of exposure it has to the US. But there will be layoffs in pretty much every single sector. Exports to the US will freeze, and just the total international demand would go down. There will be a lot of inflation in pretty much anything that you need to buy. And if you have a loan, the interest rates would skyrocket, making it extremely difficult to repay. And even the bank FDs won't be safe. Your bank accounts might freeze. All the pension funds, the insurance, the provident funds might go for a toss, and it will be a very depressing time. A more likely scenario is a slow death with QE and debt rollovers. In that scenario, the unemployment numbers would remain high for a very, very long time. India would post good GDP numbers, but inflation would contribute to most of it, and there won't be actual real job creation on the ground. Inflation won't spike dramatically, but it will keep slowly rising for a long, long period, and the RBI would find it very difficult to manage it. The stock market would give very low long term returns and stay sideways and volatile, and there would be a lot of income inequality. And if you look around, this is already happening because of the US. There's a kicker though. This is not the only debt crisis that US is suffering. People often talk about the national debt crisis, but they often overlook the American household and consumer debt, the domestic debt that they have. As of Q2 2025, the total US household debt is about $18.39 trillion. Credit card debt alone is $1.21 trillion, and the average household debt is about $7,000 on cards, and that's just the ones carrying a balance. Interest rates are brutal, 22%, with some retail cards even higher. Add in the mortgages, the auto loans, and the student loans, and the American household is drowning in $105,000 of debt. This household and consumer debt is a bubble in itself. Now, if this bubble pops, it won't necessarily cause a national default, but it will mess things up very badly. Here's how. There will be a lot of companies defaulting, a lot of layoffs, and reduction in wages, which will lead to a reduction in tax revenue, which is essentially the government's income. There could be bailouts, government relief programs, which would add to the deficit spending and the national debt. Even if only the household and consumer debt bubble bursts, it would cause a domestic and a global recession. Consumer spending would collapse, banks would suffer big losses, and housing market would crash. In the rest of the world, there will be a massive trade shock affecting the countries with big trade exposure to the US. FIs will pull money out of emerging markets like India and start buying US treasuries aggressively. And the dollar could face pressure if there is a loss of trust in the American economy. Now we will talk about a 5 step strategy to plan your investment in the light of all this. The first is to diversify hard. Explore global equities. I myself have 70 to 70% of all my equity in Indian stocks. The rest is in Nasdaq ETF, JCHI, or you can also consider indexes of emerging markets like Brazil or Vietnam. I'm also keeping 25 to 30% of my entire portfolio in cash. It is a very volatile period, and having cash in your portfolio is necessary, as in a volatile period, you need to find quick opportunities and also book quick profits, find swing opportunities, etc. And all this requires cash. The second step is to focus on inflation resistant assets. Diversify across asset classes. Make sure you have real assets or assets with a limited supply. Assets like gold, real estate, commodities, Bitcoin, or just make sure you have at least one type of real asset that you understand. I have 5% of my portfolio in Bitcoin. I have 5% locked in different debt instruments. And I'm also building a fresh position in gold. And I also have like 5% of my portfolio in other cryptos. The third and a very important step is to have a hedge against the US dollar. Now, you can do this by having assets in ETFs or mutual funds which are tied to other stronger currencies. For example, I have my investment in dollars into US equities, but apart from that, I also have indirect exposure to Chinese yuan through this ETF called GCHI, which is listed on New York Stock Exchange. I think you should also read up on crypto. You should try to understand crypto because some investors turn to cryptocurrencies as a hedge against fiat currency devaluation. But fair warning, crypto is highly volatile and a crisis like this could tank it too. Now I'm gonna tell you how can you potentially profit from either a outright debt default or a death of economy in the long term. Now, this is going to be a very advanced topic. It is highly speculative and it is very risky. So, I would honestly not advise you to get into it too much, but I'm still going to share so you might learn from it. And maybe if you're well versed with the concepts of finance, you can potentially indulge in it. That is all up to you. Now, I'm going to tell you about a very complex financial product. It's called inverse ETF. Inverse ETFs are investment tools that let you profit when the assets that they track, be it the stock indices or long term US treasuries, when they go down in value. So, this could be a product which would help you benefit very much potentially in case of a US debt crisis where bonds and markets crash. An inverse index ETF like the ProShares Short S&P 500 gains when the S&P 500 falls, while an inverse long-term treasury ETF like the ProShares Short 20 plus year treasury rises when the long-term treasury prices drop due to rising interest rates or loss of trust in US debt. You might consider these to hedge or speculate during a crisis, but they are risky due to daily resets, high fees, volatility, and the need for precise timing. If you hold them for too long, and you could lose big if the markets go the opposite way. Now, this is practically impossible, but if you think that you can time a crisis perfectly, you can even take advantage of 2x, 3x treasury inverse ETFs. These are leveraged ETFs. So if treasuries fall 1%, these go up 2 to 3%. Pairing an inverse long-term treasuries ETF with going long on short-term treasuries through something like the iShares 1 to 3 year treasury bond ETF acts as a hedge because short-term treasuries are safer and less sensitive to rate hikes, stabilizing your portfolio if the inverse ETF loses its value. So basically, you are going long on short-term treasuries and shorting the long-term treasuries. Now, this might seem contradictory. It might not make sense, which is why I tell you that this is not something to be indulging in. I only mentioned all of this to widen your knowledge, to show you that there are instruments in case of a crisis, but there are many more drawbacks to getting into something like this. So do your own study, understand this concept. Now, a much more safer and accessible method to profit from a crisis situation is to go bargain hunting post crash. Keep a significant part of your portfolio in cash and cash equivalents. After a market crash, quality stocks and assets often get oversold. For example, sometimes we keep the items that we want to buy from Amazon on our wish list. So when there is a festive season, we can buy them all at a cheaper price. Keep a watch list of fundamentally strong businesses, Indian firms like HDFC Bank or global giants like Google, and buy when the prices tank. Timing is tough, so use SIP or DCA to average your cost. Now, the final step is to protect your portfolio. You can do this by avoiding over-leveraged sectors. Stay away from companies or sectors with high amount of debt, like speculative tech or over-leveraged real estate firms. A consumer debt crisis could hit these hard. Rebalance regularly. You need to be more active as an investor. Book profits timely and always be on a lookout for deep value opportunities. Markets will be volatile, so review your portfolio every month. Shift money from overperforming assets to undervalued assets to stay balanced. Finally, have an emergency fund. Keep 6 to 12 months of your expenses in either a liquid fund or savings account. If layoffs hit or interest rates spike, this cushion will keep you afloat. That brings us to the end of the video. If you did learn something new, do press the like button.